when you're doing rebalancing in small cases, should you go with the suggestions made by your small case manager to exit a particular stock or add a stock?
So actually you can go on the Smallcase platform and you can download the daily returns history also.
Should we go for SIP investing in small cases, or should we stick to lump sum investing in small cases?
So your small case is running in broker A, whereas you have opened one more brokerage account, let's say B, where you are doing this experiment.
Right. Hi everyone. Today, I am very pleased to say that on this channel, we have crossed 300,000 subscribers. I never thought we'll get to this milestone. So a very big thank you to all of you who have supported me on this journey. And today, I'm also celebrating this journey with one of my friend, Vivek Sharma here. This is my first video where I have got somebody in person sitting next to me shooting a video. But more importantly, what we really want to do in this video today is talk about small case investing, a topic that many people are ignorant about. That's why I have Vivek here with me, who is an expert small case investing. Vivek has close to 18 years of experience, Vivek, now? 18 to 20 years of experience in investing. And Vivek has created his own small cases. We'll talk about that in a minute. But a very big disclaimer, this is not a promotional video. The intent of this video is to bring you a lot of small case knowledge from an expert's perspective as well. With that, let me quickly introduce Vivek to you. Vivek is head of finance at ST, and ST is a company that has created few good small cases. For example, Gulaq is one of their flagship small case product that they have in the market. Again, I'm not doing a promotion here, but I'm just giving you a background of what Vivek does. Vivek, with that, over to you. Why don't you introduce yourself to our subscribers so that everybody can know you a little bit more and your investing journey as well, please.
Okay. Thank you, Rahul. Thank you for having me here.
Thank you.
And congratulations to you for reaching this milestone. I think the way you have built up this channel overall, it's pretty amazing. The way
Thank you so much.
Contributing to the investors, I think it's really commendable. Yeah. So as you said that I have almost 18 years of experience. By education, I'm an engineer, but I always liked stock markets, investing, finance. So after doing my engineering, I shifted to financial field only. So for the last almost 18-19 years, I'm into this field. First of all, I was trading international markets, energy markets, commodities markets, and over last 7-8 years, I'm totally into Indian markets.
Right.
And primarily into systematic trading, the algorithmic trading or the quant investing, what is popularly known as, in that field. So currently I'm working with the ST advisors as the head of investments, and we have few portfolios on Smallcase platform.
That is excellent. So guys, what we're going to see today is a lot of expert insights into not only just the small case investing, but overall equity market in India. And as Vivek said, last 7-8 years, Vivek has been managing the equities in India, which has been doing pretty well, especially post-COVID. Many of us have started investing in Indian market. So the opportunities in Indian markets are huge. But with that, let me start with small case investing. We are going to cover 5 topics that people are very ignorant about. With that, let's deep dive into small case investing. So the first topic that we are going to pick is the difference between stock investing, mutual funds, and small cases. So what is the difference between that? People already know, but when to use which asset class is what we are going to decode. And primarily, Vivek, let's take risk versus rewards as one of the criteria to evaluate these 3 asset classes so that people understand what is the most suitable asset class for their own investing, right? So let me start with risk, Vivek, right? So in my view, if we invest in direct stocks, the risk is very high. Yeah. And when I say risk, I'm not talking about volatility here. Volatility is that today your portfolio is down by 5%, 10%. But ultimately, risk here means that there is a risk to lose your capital. And one of the golden rule of investing is that first, you need to protect your capital. Forget about returns. Returns comes later, but it's about protecting your capital. And most people, especially retail people, do not know how to pick stocks. And eventually they end up losing money, right? When I see that, it hurts me a lot. I'll give you examples. I have done that as well. I've lost a lot of money. So Delta Corp, one of the stock that many people have lost money. It's down by almost right now 38% in last few months. There is nothing fundamentally wrong in the stock. So when you're picking this stock, there's nothing wrong. But you still lose money because there are hidden risks with specific stocks. So in my view, stock investing is very risky from a retail investor's perspective. You must do it only if you're having conviction as well as you understand the nitty-gritties of stock management, right?
Yeah.
At the same time, mutual funds, I did actually a screener on ticker tape, and I screened more than 1,300 mutual funds. And if I compare them on the last 3 years CAGR returns perspective, I found only 13 mutual funds that have given negative returns, right? So it's not even 1%. So the chances of one losing money in mutual funds is close to none. I mean, if you're really stupid and get into a very wrong mutual fund, you're likely to lose money. But otherwise, the chances of you losing money in mutual funds is zero, provided you stay invested for minimum 3 years, right? Lastly, if I talk about Smallcases, I went to Smallcases website and I sorted out all these Smallcases in the order of low to high, right? In terms of last 3 years CAGR returns. And to my surprise, I did not find a single Smallcase where the return was less than fixed deposit returns or negative returns. I mean, most of the Smallcases have given close to 10%, 12% CAGR return on an annual basis. So my personal conclusion was that from a mutual funds perspective, Smallcase has given better returns and the risk of losing money is very little, right? Now, let me just talk to Vivek about the returns per se between stocks, mutual funds and Smallcase. So Vivek, over to you. What do you think from a returns perspective?
So I think one thing is very clear that if you are doing stock picking on your own, maybe in short term you can make very high returns.
Right.
But
right.
that is maybe short term, maybe few months or maybe 1 or 2 years. But it's really very, very difficult to sustain those returns over very long period, let's say 3 year, 5 year, 10 year. It's a very risky thing to do.
Right, right.
Because see, in stock picking, you have got to know about so many things, right? Which is the best sector.
Right.
Within that sector, which is the best company. And what happens is maybe you identified a very good company, but if the market doesn't agree with you,
right,
the prices won't increase.
Right.
So maybe it's a phenomenal investment. It's a very good value buy. It's
right.
Undervalued company. But
right.
if market is not recognizing, then the prices won't rise. So there are a lot of risks in individual stock picking.
Right.
So that thing I think is very clear. I think you very rightly said it's very difficult to lose money in mutual funds.
Yeah.
If you just pick whatever mutual fund, whichever way you want to pick, but if you pick a mutual fund, stay invested for 3 to 5 years, it's really very, very difficult for you to lose money. I think Smallcases, it's a new investment class which has come up in the last few years. Pretty interesting way it has built up. In terms of returns, definitely I think there are a few Smallcases which can give you higher returns than mutual funds. But at the same time, what you've got to think about is the other side of the equation, which is the risk.
Right.
So the risk is also higher in those Smallcases.
Right.
So that's what happens. So there could be very, very concentrated Smallcases, say 5 stocks, 8 stocks, 10 stocks. That is possible. And if they're doing well, obviously they'll give you much higher returns than a mutual fund, which typically has at least 30,
50, 40
or 50,
stocks.
Or even 80 to 100 stocks as well.
Exactly,
right?
exactly.
So if you have much smaller number of stocks and if an expert is picking up, it's likely that it will do well. But obviously the risk is also slightly higher than mutual funds. That's what I think.
Okay. So I think what you are trying to say, Vivek, is that it really depends on the Smallcase that you pick up. It really depends on the theme that you're going after. If you're going after a theme, right? Smallcases may generate higher returns because the number of stocks that are there in Smallcase are less than mutual funds. So you are going very targeted, right? You're being very, very specific.
Exactly.
So the chances of you generating returns might be slightly higher from mutual fund, but again, depends on what you're picking up, what is the methodology of that manager and things like that, which we will of course talk about.
Yeah. True.
So that was really great to understand the difference between stocks, Smallcases and mutual funds. Let's move to our topic number 2, which is how should we go about choosing a Smallcase, right? There are various parameters, I know, Vivek, but let's just try and unpick this particular aspect. So what do you think if I want to go and invest in Smallcases? What should I look for?
Okay. See, for most of the investors, if you want to take a hands-off approach, if you really don't want to get too much involved in it, and or if you don't have time, you don't have interest. So the best thing that you have to do is pick a broad-based small case portfolio. When I say broad based, it shouldn't be a thematic one.
Right.
It shouldn't be based on a specific theme which is likely to work in some time and then it won't.
Right.
Like themes are like, let's say, Make in India. That's a theme.
Okay.
Or green energy. That's a theme.
Right.
These are multiple. There are multiple themes.
Right.
Now there's budget going to come, and there'll be few themes which will come up, and few themes which will be out of flavor.
Right.
There's a lot of risk if you want to pick up those themes.
Right.
So if you want to take a hands-off approach, that's what I suggest. That investors,
Especially for beginners, isn't it?
especially for beginners, or especially for people who don't have time or skill set or
Exactly.
interest also. So pick a broad-based theme in which the manager is not specifically selecting, just putting your money in one theme.
Right.
So it should be broad-based. It should not be, let's say, managers just picking small cap stocks or
Right.
mid cap stocks.
Right.
Because what happens, the small case, like right now, the small case, everyone is saying that it's overvalued.
Right.
So maybe now the good opportunity is in large caps.
Right.
So don't pick.
Don't restrict yourself into a specific theme, basically.
Exactly.
So you should be
try to pick a broad-based theme portfolio.
right, agnostic to market cap. Look at look at the entire market, and see where the opportunity is.
And then
your manager should go and pick. Why should you restrict yourself to one particular theme?
Yeah,
right.
yeah.
That's
I think that's the biggest point one should consider
right.
while picking. I think those thematic. Even mutual funds, thematic mutual funds or thematic small cases are meant for maybe 5 to 10% of the investors
Okay.
who have that time and bandwidth to actually research when a theme is about to pick up
And
when to exit also. That is very important.
So it is very similar to then picking up individual stocks. But it's just that you're not going at individual stock level, you're picking at a theme level,
Right.
But still you need a lot of research.
Exactly.
Still you need a lot of time to when to enter into this theme, right? As you rightly said, post-budget, there might be some particular segments that might flourish.
Exactly.
But then when to come out of it,
When to come out of it also.
People wouldn't know that, especially the beginners.
Yeah, timing becomes very important in these thematic plays.
Right. Okay. So your idea is that if people want to go for small cases, especially people who do not have a lot of experience, they should look at small cases that are broad-based theme basis, right?
Yeah.
Agnostic to market cap, agnostic to maybe sectors. Right?
Agnostic.
So that you're free. Your small case manager is free to pick the stocks. Yeah.
Yeah.
Okay. What about the small case managers, for example? How should you go about evaluating them?
Yeah, I think one should also consider, this is a very good point, that one should consider the past experience of the small case manager also.
Right.
Because one good thing about small case is all the managers are SEBI registered. So
Right.
either they are SEBI registered research analyst or investment advisors.
Okay.
So that's one good thing. But what can also happen is typically a small case manager might not have too much of experience also.
Right.
So just look at the experience, what he has done in the past 5 years, 10 years, what all he has done. And the small case portfolio that he is managing, again, what's the live track record?
Right.
So that is very important, right?
So
Having a
is
live track record is, I think, quite important.
Right. So Vivek, is it possible that tomorrow if I take a SEBI license, it's very easy to create a small case versus becoming a mutual fund manager? Would you say that?
Yeah, obviously. In
Right.
mutual fund, it's much more controlled environment,
Right.
which is a good thing also. Good
Right.
thing for investors. Right?
Correct.
So that's the difference between small case and mutual funds.
So I think from a methodology perspective, what we are trying to say here is that look at the broad-based theme small cases, especially if you're a beginner or an investor that have just started your investment journey. And secondly, look at the small case managers' track record, see their experience, because I think Vivek just alluded to a point that there are SEBI registered advisors who are now creating small cases left, right, and center. They might not have more than 2 years, 3 years of experience. So that is a possibility as well. So you need to pick somebody who is got 10 years, 15 years of experience maybe, or who has been into this area for a longer period of time, have given healthy returns in the past as well. That becomes a very, very important point. And also I think Vivek, last thing is, I can see on the small cases website, nowadays, even for small cases, there are financial ratios that are available, right?
Yeah,
So
yeah.
alpha is there, beta is there. There are the ones that we use to pick the mutual funds that are also there in small cases. So maybe we should look at those financial ratios
definitely, as I said, a small case should definitely have its past track record.
Right.
So actually you can go on the Smallcase platform and you can download the daily returns history also if you want to look at it and see how volatile it is or how it would have done in last year. 2022 was a very flattish year, so it's good to have a look at how the small case would have performed on all of those years and then take an informed decision.
Brilliant. So this is what we are talking about in terms of how to go about picking the small case for your investing journey. Do not get bound by specific themes, sector specific themes, unless you are expert into that area, because the risk of losing money still remains in small cases. Let's move to the third topic, right, which is I think most frequently asked question, that should we go for SIP investing in small cases or should we stick to lump sum investing in small cases? I mean that question is also valid for mutual funds as well. But let's now talk specifically on small cases as well. So Vivek, what do you think investors should do? Should they go for SIP? Should they go for lump sum? Should they adopt mix of both? What do you think?
So I think it's a very, very interesting topic also, and very common doubt that people have. So I think first of all, most of the investors are kind of salaried people, right? So they get their monthly salary. So I think SIP is a very, very good tool to use while investing. So every month when you're getting your salaries, it's a very good habit that you save a small part and put it into investments wherever you are saving. So SIP definitely is good. Very good tool. The doubt comes when you have a lump sum. Let's say you get a good bonus or you get some money from somewhere.
All of a sudden 2 lakh rupees is with you. What do you do now?
So what do you do now? So I think the data, I've done a lot of research and the data suggests that roughly about 70% of the time it will be beneficial if you do lump sum investment rather than SIP. Because market mostly it's going up. Right. So it will be in their favor about 70% of the time. Rest 30% of the time, if the market comes down and you have done lump sum, then you will be in slightly loss. Right. But the odds are in your favor.
If you go with lump sum.
But what we have also got to understand is for many, many investors, they become very anxious if they have to put money because they'll keep thinking, what if the market falls down?
From here.
Right. So what I suggest is, and one of the things that they use is, if the market falls 5%, I'll put X money. If the market falls 10%, I'll put this much money. So I don't think that's a very good plan. Because what if the market doesn't fall? And we've seen that in last 2-3 years, the way market has come up, people really didn't get too much of correction and to enter.
There was never a chance to enter because you were like waiting. And if you're a long-term investor, then why are you waiting? The question is, why are you waiting?
So a better plan is, if you really don't want to do lump sum investing, a better plan would be you divide your whole investments into, let's say, 3 or 6 or 9 parts. Let's say you divide it into 6 parts. Now, every month, on the first of every month, you put that 1/6 money into the fund, whichever you have chosen. I think that's a very good strategy, because then you are not dependent on the markets. Within 6 months, you'll be fully into the markets.
So basically, hybrid.
And if the market falls down at a sharp pace, then maybe you can increase the pace of investing. So instead of 1/6, you put in more.
Okay, so that's a very interesting point of view, Vivek, actually, which you're talking about, the hybrid sort of a approach that people can take. I'm not a SIP investor, by the way, myself, and I think I fall into this category of having, if I have the capital available, because capital is a problem all the time. Whenever I have capital available, I continue to do my research, right? And whenever I know that this stock, because I'm 80%, 90% of my investment right now is in actually individual stocks. And if I like a stock, what I do is typically park that money into it, right? So of course, I don't have unlimited capital. If I did, why would I invest? Maybe that's a topic for some other day. But yeah, I think the point here is that SIP investing has its own pros and cons, as is the lump sum case. And people need to look at maybe hybrid approach in these environments so that you don't miss out on opportunities, as well as if market corrects, you're still not losing a lot of money if you remain invested. That's it.
See, the point here is also one thing that we haven't spoken about is for how long you are investing. So if you're investing for, let's say, 5 years or even longer, I really don't think there is too much of risk involved in that, right? As we have earlier seen, it's really hard to lose money if you invest for long term, right? So that is one very key point that one should keep in mind, because if your investment horizon is just, let's say, about 1 year or so, then you should not get into equity at all.
Yeah, exactly. Why are you getting into equity, right?
Exactly.
Okay. Brilliant. Let's move to our topic number 4, which is again one of the very frequently asked questions, Vivek, which is when you're doing rebalancing in small cases, should you go with the suggestions made by your small case manager to exit a particular stock or add a stock, or should you try and intervene depending on your analysis? So what's your take on rebalancing it?
So Rahul, जैसे हमने थोड़ी देर पहले बात की है कि one should not get into individual stock picking. It's quite risky. So I think if you actually are playing around with what your manager has suggested, it's same as individual stock picking. So I would recommend not to do it. So follow your manager, whatever he is recommending 100% of the time. I would recommend that. Having said that, there might be few people who are into stocks, who are researching a lot, and they might have their own views. So Smallcase as a platform allows you the flexibility to tweak around. But I would not recommend that. If you really want to do it, do two things. First of all, do it with a much smaller capital. Right? And second is, you do it in a different brokerage account. So your small case is running in broker A, whereas you have opened one more brokerage account, let's say B, where you are doing this experiment. And do it for some time. Do it for 6 months or at least 1 year, so that you get to know how well you are able to do as compared to the small case manager. And if you are able to do it well, then you can increase. But maybe to begin with, if you really want to do it, maybe do it with 5 to 10% of the overall capital, not more. But my recommendation is not to try.
So that is a very straight point that Vivek has talked about, that if you want to go for small cases, during the rebalancing, you should stick to your small case manager's suggestions of adding stocks or exiting stocks. And the best way to track the effectiveness of your small case versus your portfolio is to have 2 brokerage accounts. In one account, you build your own individual stock portfolio. And in the second account, you have your small cases attached to it, so that you're able to compare the returns between small cases and your own portfolio. And you can decide whether stocks are good for you or whether small case is working out better for you. So that is a very straight point. I really like it. I hope you also enjoyed it. And so far, if you're liking this video, hit the like button. Let me know in the comments a simple thank you. I will also thank Vivek, of course, for this wonderful video that we're doing. And let me know in the comments if you would like to see more and more guests on my channel. I will do my best to reach out to more experts, bring you this knowledge so that you can have this knowledge at zero cost. Let's move to our topic number 5, which is many people are confused about taxation for small case gains and losses, right? So short-term capital gain, long-term capital gain. Let me quickly give you a simple 20 seconds commentary. So short-term capital gain is if you hold a stock for less than 12 months and if you make any profit, right, then on that profit you will have to pay 15% short-term capital gain, right? If you hold a stock for more than 12 months and if you make any profit on that particular stock, then you will have to pay long-term capital gain tax. And long-term capital gain tax is taxed at 10%. But more importantly, the first 1 lakh on that long-term capital gain in a particular financial year is tax-free, right? So that is definition for stocks. Exactly the same rule gets applied to small cases as well, right? There is no difference between individual stocks or small cases. So that is as simple as it gets. But more importantly, Vivek, what do you think from a mutual fund taxation perspective and small cases perspective? What's the big difference that I think people may not understand?
So I think one of the big difference is mutual fund is a very, very tax efficient way of investing. So let's say I invested in one mutual fund and if I redeemed after 5 years, I really don't need to pay taxes every year, even though it might be giving some profit, right? But I don't need to pay because I haven't redeemed, I haven't booked that profit. So only after 5 years, and as you said that if you're holding it for more than 1 year, it will be under long-term capital gains tax and it will be just taxed at 10%, right? Same is not the case with small case because those stocks are held in your name,
Right.
with your broker.
Correct.
Right. So whenever your manager is recommending to buy or sell, your profits are getting booked, whether
Right.
they'll be short term or long term, but your profits are getting booked, and accordingly you'll need to pay those taxes.
Taxes.
They'll still be 10% and 15%, whether
Right.
it's LTCG or short term capital gains tax, but you'll need to pay those taxes. So net, if one mutual fund is having same return as that of small case, it is always beneficial to go with mutual fund because it's more
You're
tax
paying less
efficient.
taxes. Okay.
Yeah, it's only beneficial in small case if your small case portfolio is able to give you higher returns, so that even after paying those taxes, you end up in profit, you end
Yeah.
up better than mutual funds. Only then it is profitable. So just take that into account when somebody is investing into small case portfolios.
Right. Okay. So I think in summary, if a mutual fund manager is selling a stock and he's gaining some profits on your
Yeah.
behalf as
Yeah.
an investor, actually he's not paying any long-term
Exactly.
capital gain
Yeah.
or short-term capital gain. Right?
Right.
But in small cases, the moment you exit a stock, you are realizing the profits or losses,
Right.
and therefore you're paying taxes on that long-term capital gain or short-term capital gain, right?
Yeah.
So from a tax efficiency perspective, mutual funds are better than small cases because of this very reason, right?
Yeah.
Okay, that's great. Now, what about the responsibility of these taxes? Is that, let's say I today go and subscribe to a small case and I make, I don't know, 50,000 rupees in a year. Is it that I need to pay tax on this, or will my broker take care of it, or will the small case manager will pay? How does that work?
So small case manager is his responsibility is on advising you
Right.
what to buy, what to
What
sell.
to not buy? Yeah.
Your broker's responsibility is actually executing those trades.
Correct.
But since you are making those profits, it's your responsibility to file those taxes.
Right.
But it is very easy. The brokers that I use, it's very easy to download the reports,
Right.
the taxation reports, and it gives you very clear-cut indication as to how much money you have made or lost in mutual funds versus individual stocks versus FNO if you are doing that.
Okay.
So those reports are very easily available through your broker.
Right.
But the responsibility is
With the individual.
With the individual.
So what we'll do is, in this video, Vivek will try and show a demo of one of the popular brokers. Again, not a promotion here, but we'll pick up any broker and give you a clip to see how easy it is to go and download a report simply. That will give you short-term capital gain, long-term capital gain, and accordingly, you need to go ahead and file your returns. Share it with your CA or your financial advisor, and you can go and file your own returns. Not a problem at all. So in order to download your short-term capital gain or long-term capital gain, simply go to your broker account. So for example purposes, I am going to Zerodha here. Click on the console here. When you click on the console, then you go to this screen here. Click on the report section here and click on the tax P&L. When you click on tax P&L, you will see this screen coming up. Simply select the financial year or the quarter if you want to go quarterly, and just click on this button here, and you will see the short-term capital gains and long-term capital gains coming here, and you can easily go ahead and file your income tax returns. So with this, we come to the end of this video. Thank you so much for watching this video. And as a thank you, Vivek is offering some discount on Gulaq 6 as the small case. If you want to consider, you will find the link in the descriptions. But let me put again a very disclaimer. It is not a promotion of Gulaq's small case, right? We have tried to give you a lot of knowledge around small case investing. I'm sure you will have still a lot of questions lingering in your mind. Let us know in the comments. I and Vivek will personally go and try and answer to as many questions as possible. Also hit the like button and let me know in the comments if you would like any special guests on this channel. I would try and reach out to them, and if they are willing to come and shoot with me, I'll be more than happy to spend more time so that you get to hear a lot of diverse views on finance and investing and continue to learn, because learning is earning. With that, I'll see you in my next video. Until then, keep rocking.